Good day, this is your European Open briefing for Monday, 1st August. My name is Michael Florentiades, I am the Chief Economist here at XM.com. And today's main points that we should look, first of all, the US GDP. It was much worse than expected. Coming in on Friday, this was Friday's news, of course, but it was much worse than expected at 1.2%. Analysts were expecting 2.6% expansion, so a big miss in the gross domestic product, the output of the entire economy. GDP sales were also worse at 2.4% versus 3.2%, so not only inventory downstocking. So the story. So as you can see from the mid-2014, we have a slowdown of the US economy. We have the past 3 quarters around 1%. This is due to negative inventory levels, destocking, but it shows that we have some deceleration, which, despite the fact that it is more or less temporary factors maybe keeping it down, it could prevent the Fed from hiking interest rates. Now, consumption did well, but which is the biggest component of GDP, but other components such as business investment, government spending, and net exports did very poorly, so they had a negative influence. In other notes, I would say that the GDP deflator, a measure of price increases, BEAD estimates it by coming in at 2.2% versus 1.8%, so a little bit faster than expected GDP deflator. And also another part on wages and benefit, quarter on quarter, they are suggesting a 2 to 2.5 annual pace the annual pace of wage increases and benefit increases. So the markets latched onto the poor GDP figures. Remember, we had a relatively dovish FOMC statement on Wednesday, so you see first the dollar selling that took, this is a dollar index by the way, dollar selling that took place right after the FOMC, and the other dollar selling that took place right after the GDP numbers. What does this mean for rate hike expectations? A September hike is now off the table, while a December hike has a 1 in 3 chance from a 50-50 chance before the GDP numbers. So what happened? Once more, I think dollar bulls got hurt by a dovish Fed and data showing mediocre performance in the US economy. Still, I think this is more of a dollar correction. How severe it will be remains to be seen, of course, rather than a new downtrend in the greenback. And this suggests more range-bound behavior for the US dollar. People who are looking for the dollar index to break above 100 will probably be disappointed in the medium term. Now, the other news that is has really rocked the markets, let's say, was the Bank of Japan failing to live up to expectations on Friday morning by doubling its ETF purchases, exchange-traded fund purchases, to 6 trillion yen from 3.3 trillion. This disappointed markets, which were expecting even more QE. The Bank of Japan left it stable at an 80 trillion yen annual pace, and or a cut in the already negative interest rate of minus 0.1%. Still, the Bank of Japan said there was going to be a review of the effectiveness of the negative rates and asset purchases for its next meeting in September, so there could be some more stimulus brewing after that meeting. So we have to see. It doesn't mean that Bank of Japan extra stimulus is off the cards. Still, we had a pretty violent reaction. You see the dollar yen falling to around below 102 at some point. Now it's around 102.5. So the yen rose, but dollar yen is unlikely to reach 100, I think, because we have this anticipation that there could be some more stimulus from the Bank of Japan. On to today's calendar, we had some Chinese PMIs earlier. The Caixin final manufacturing PMI was much better than expected 48.7 coming in at 50.6. And however, we had some slightly worse than expected National Bureau of Statistics manufacturing PMI, but that's a very slight miss. We had some improvement in Japanese manufacturing PMI, and Eurozone final PMIs, not much surprises, if anything, some better than expected. And looking forward to today's ISM manufacturing later on. Just a reminder of major events this week. On Tuesday, we will expect the Reserve Bank of Australia decision on interest rates. On balance, the RBA is more likely to cut than not, although it's not a done deal, it seems, from what the analysts are saying. We have the Bank of England on Thursday, there's more of a consensus here that we will see an interest rate cut of 0.25%, leaving interest rates at a record low of 0.25%. And of course, we have non-farm payrolls and the US employment report on Friday. We are expecting non-farm payrolls to rise by 175,000 and the unemployment rate to stay steady at 4.9%. So, all in all, an eventful week. Thank you very much for watching and have a great day.